Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify.
Now, Al, as we get into this segment here, I want you to first off finish the futures market, explain what that is, but reference that into why the institutions are utilizing those different assets in retirement accounts as well.
Mm-hmm. Yeah, the futures market really is well named. It really is looking at something in the future, what something is going to be worth in the future, whether it's up or down. And it can be all of the major stock markets. It can be commodities, any of the commodities. It can be oil, gold, silver, currencies, interest rates, a variety of things. If someone wants to trade commodities like corn really has nothing to do with or doesn't care what the S&P 500 is doing, so there's really no correlation there. That's where you get into good diversification. And futures probably is the best overall market for that diversification. You can have some things in there that are correlated and some things that are non-correlated.
And just think about this too, Al, with these markets, with the big swings that we're seeing, that's a good way to protect people's portfolios, right? Because if you can hedge your portfolio, if the stock market is going down, there's futures contracts that are going up.
That are going up.
And that's why the institutions use those.
Yeah, and the institutions oftentimes can be long one futures contract and short another futures contract and be profitable both ways, both directions. So there's a lot of versatility there. Futures trade essentially 24 hours a day, 23 hours and 45 minutes. Great liquidity again. And then people, I know if any of the listeners have friends that have traded the leverage assets, they're probably going to say, well, if the leverage can go in your favor, you know what can happen? It can go against you. And that is true. That is why the number one thing that everyone needs to take into consideration, and the institutions are masters at this, is to have risk protection, risk management.
And that's the same for the stock market, too. I mean, you always want to do that.
Anything that can go up or down in value, anything that can have a change in value, risk management is a key part of it. It is the number one thing. If you only learn one thing, then that is where you want to be an expert. And the institutions, one of the reasons, or like two of the reasons that they are successful is, number one, they place probabilities in their favor. And then they know how to protect what they have, and they know the right assets to use during different market conditions.
So this sounds like it's more of a probability game, right?
It is, and that's what we're not predicting the future. What we're doing is trying to increase the probabilities. It's like a casino. If you walk in the street into a casino, you better know that the casino, the house, has the probabilities of being successful. You very seldom have ever see a casino go out of business because all of the people coming in to gamble are winning and taking all of their money. It's probabilities. And how do you put the probabilities in your favor? A couple things. Number one, how do the institutions do it? Well, they have research and data that they're paying millions of dollars a year for that we as individuals are not going to get or get too late to really take proper advantage of. So that's part of their edge, is having that data, which gives them the ability to put a proper price on something, whether they're entering into a trade or exiting a trade. And that's one of the things that makes it important to be able to follow what the institutions are doing. They have that probability. That's part of the probabilities that our students also learn. And then identify, and this is something we talk about in these classes, how we utilize a strategy to identify in advance when institutional trading is going to take place. That is something that is part of an evaluation process. That should not just be identifying, say, a price that an investor thinks an entry into a position might happen or an exit, but then qualify it, grade it, and make sure that this is a high-quality position where you have a low-risk entry point, high profit probability, and then also protection if you're wrong.
And it all comes down to, like you had referenced in the first segment, it all comes down to supply and demand. And it's where those banks are buying, but also where those banks are selling. I mean, Al, I don't know about you, but I feel this is probably one of the greatest times to be in the market. And I'm not saying just buying, but buying and selling.
Correct.
That's what the institutions are doing. But now is probably the best time to understand what they're doing, why they're placing their trades at certain price points and understand how the financial markets work, but also how these financial markets work with other asset classes, the futures market, the Forex market, and the options market. I want you to get into that next year.
Right.
Al, let's get into the retirement side of things, because the institutions are utilizing these other asset classes in income accounts and retirement accounts. Can we trade and invest in our retirement accounts with these other assets, like options, we'll say?
Well, if you have a self-directed retirement account, you can do that. If you have a 401k or 403b or an employer-sponsored retirement plan, the answer is probably no. Typically, what's available in those types of accounts are mutual funds, maybe some exchange-traded funds, which is similar to a mutual fund. It's a basket of stocks.
We call it an ETF.
It's an ETF is what we usually call them, and there are thousands of those that cover pretty much anything you can think of in the financial markets. But some 401ks, 403bs will include those, but most of them it's mutual funds. So there's a limitation there, and it's limited to assets that will only provide a profit if the market is going up in value. So there's a limitation there to participating in the downside or a sideways market. If you have a self-directed IRA, the choices are very wide. The choices include futures, Forex, options, stock, ETFs, mutual funds, a variety of things that give you the ability to have an opportunity to participate in all different market directions and to have protection on a portfolio. In a 401k or 403b, there really is no protection. You can't participate in a downward market. Mutual fund managers can't short the market. They can't go to all cash.
So think about that. That's missing out on a lot of opportunity.
It is. And people that were in the market in 2000 and 2008, and a lot of those are our students now because they went through two major drawdowns where close to half or more of what they had worked 30 or 40 years for just disappeared when we went through those crashes. And that's something that you really want to eliminate. Don't work 20, 30, 40 years. Work hard, put money into what you think is going to get you through retirement, and then have a big portion of it taken away because the market goes in a different direction. That protection is available in a self-directed IRA. And also, even if all you have is a 401k or 403b, a portfolio could be set up outside of it to hedge the assets that are within those accounts. Again, these are things that we talk about in these classes. You can keep this as simple as possible, or you can take it to higher levels. There's a wide variety of opportunities that are available, but I think the first step is to find out whether this is something that is right for you, and that's what these classes are designed to do.
Yeah, and just to clarify that, too, when you mean self-directing, so are you saying if an individual has an IRA managed by, we'll say, we won't even mention anybody, but just an advisor or a broker, can they... They're not required to have them manage it. Can they, if an investor wanted to take that and manage that themselves, obviously to learn how to do it first. But if they wanted to do that, is that possible?
Oh, absolutely. It's possible. All trades have to be placed through a broker-dealer, but you don't have to use a broker, a person, an advisor, to enter or exit a trade.
And remember, there's probably people out there that still probably call their broker to place those trades, which costs a lot of money.
Well, of course. And a lot of people are conditioned to do that because years ago, that's the only way you really could participate was to call a broker.
It's electronic now.
And I know that because I used to be a broker, and that's the way it worked. But an individual can set up a self-directed account where their fees are not being applied. And that is one of the big disadvantages of having a 401k, 403b, or an advisor-controlled account portfolio.
Are the fees lower if an investor has ETFs? Are they lower than mutual funds?
Exactly. That's one of the reasons that ETFs are attractive. Mutual funds have a number of fees within them, most of which an investor will never see or hear about. ETFs have very low fees. And one of the biggest advantages is that ETFs can be traded. They're traded like a stock. So they can be purchased or sold at any time during the day when the market is open, whereas a mutual fund can't. You cannot buy or sell a mutual fund during the day. It has to you have to wait until the market is closed.
And Al, we have a lot of listeners. I mean, we have people listening to the Retire Young radio show and the podcast, and I think it's 12 different countries right now. But a lot of listeners have retirement accounts, and they just let their advisor or broker take care of it, and they don't even sometimes open their statement. Which that's what people work all their lives for, is to have these retirement accounts. Well, the institutions are typically doing something totally different in their accounts than they're putting their clients into.
That
we talk
correct.
about that a lot,
Right.
Every single week, and just to understand just having more financial literacy and understanding more of what's in your retirement account. Is it mutual funds? Is it ETFs? We talk a lot about in these investing classes because a lot of people just don't know or understand. Sometimes they feel they don't want to know. It's just because they haven't learned it yet.
Sure.
Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.